I'm able to catch setups like these every single day, and it's the PO3 strategy that helps me. The strategy is very, very simple. It only has a couple of steps, and this is the ultimate guide for it. And in this example right here, I caught this live and caught a nice 3R. And then in the next couple of minutes during the duration of this video, I'll be going over the 3 simple steps and how to properly use the PO3 so you can catch setups like these every single day, just like how I do. So in this PO3 guide, we'll be going in depth into all the reasons why the accumulation, manipulation, and distribution work. We're going to be taking a step-by-step approach and actually analyzing why the accumulation, the manipulation, and the distribution actually happens, and the reasoning behind why it works every single time. So the first out of the 3 is the accumulation. Now you must wonder, why does an accumulation always happen, or why is it needed to happen? So why does the accumulation actually happen? Accumulation happens for one simple reason. Big money is trying to fill their orders, and that's what's necessary in order to fill it. So let's take a look at this example right here. Let's say an institution has a $50 million order that they want to fill. So in order for that $50 million order to be filled, it must be in small different sizes and small different lots. Now, if we logically think about this, if somebody fills a $50 million or $100 million order, the market will automatically see a rejection, and that cannot happen. Now, let's think about it logically. Let's say that $50 million order was to be placed at a single time. What would happen to the market? The market would absolutely just react off that order. So in order for the orders to actually be filled, there has to be some sort of small process, and that process is an accumulation. Let's say each order is 1 million at a time. So let's say we have a $1 million order filled here. We have another million right here, another 5 million right here, until the accumulation is done and the market orders have been filled, and that position size is right there. And that's why there's so much liquidity behind these accumulations. And this accumulation is the reason why our strategy actually works. We always want to position ourselves behind the big money and follow what they do. With this accumulation out the way, we can go on to the next step, which is the manipulation of that accumulation. Now you might be asking, what is a manipulation and how is it valid? So the premise behind manipulation is, when we have that accumulation with all these big money loading up their orders, they need more liquidity in order to fill these orders than continue to their original direction. So let's say we have this accumulation right here. What is the manipulation used for? It is to induce liquidity and actually get those orders filled. So what would a manipulation for a sell side delivery look like? It would be taking all the accumulation and the money that's delivered right here, taking all that liquidity, filling their order up here, and then continuing lower with that accumulation. So over time, money has been generated with all these sell stops over here. So what does the market want to do? What does the big money want to do? They want to fill these orders, collect those sell stops, which induces liquidity into the market as people are losing and it's going back into the market. And we go off that manipulation for the distribution. Now, the beautiful thing about trading is that we must understand that all things are fractal. So what I mean is, if this is happening down on the lower time frame, there's something else happening on the higher time frame. And we can clearly just visualize what this looks like on the higher time frame right here. And as you can see, this candle right here is the representation of what this is on the higher time frame. Now, how does this make sense? So let's say we have our key opening right here, which is the 10 a.m. 4-hour candle. As we know, the 10 a.m. opens up, and that's the new 4-hour candle that opens up during New York session time. So let's say after that 10 a.m., we have this accumulation. Now with that accumulation, we're inducing liquidity into the market so the big money can fill their orders. So at this moment, the candle opens up right here. There's barely any bottom wick. As we know, the lower time frame is a fractal of this higher time frame, which means that whatever happens on the lower time frame is just put into one higher time frame candle. So let's say this is the 1 minute chart. This from 10 a.m. all the way till 11 a.m. is just going to be one singular candle right here. So with this in mind, we can represent that this is the lowest point that has gone in that hour. So this is the wick of that candle. And at the moment, this is the highest it's gone of that candle. So this is the top of that candle. With this being said, we can understand that there's barely a bottom wick, and we can anticipate a possible reversion. So before getting into the distribution, how do we know that the manipulation is actually valid? And a lot of people struggle with this when using the PO3. They really trade the manipulation rather than the distribution of that PO3 candle. Now, there's a very, very simple step-by-step process that I'm going to explain to you in just a minute. So let's say we open up at 10 a.m., we have that accumulation, we then have a manipulation. Now, how do we actually know that this is going to be valid right here? All we're going to do is look for some sort of higher time frame PD array. Now, this higher time frame PD array can either be a significant ERL or a higher time frame fair value gap. So I highlighted a fair value gap right here. And how do we know that the manipulation is valid? So the number one step is there must be a higher time frame fair value gap in that PO3. Without having a fair value gap or a significant ERL, which is a swing high or swing low, it is pretty much impossible to know when the reversal will actually happen. So boom, first off, we have that higher time frame fair value gap, check number one. Check number two is a higher time frame SMT inside of that fair value gap. Now, what is an SMT? All it is a crack of correlation between two diverging assets. So this is an SMT right here, as ES makes the higher high, while NASDAQ fails to make that higher high and continues lower. This is a bearish SMT. So based off that, there must be an SMT beforehand. So what I like to do is wait for the liquidity sweep / SMT to occur. Then I look for the third step. So this is how we're looking right now. And the next step is going to be the distribution. So now finally onto the distribution. This is what you guys have been all waiting for. Now, why does the distribution actually work and how do you know that it actually happens? Now, as you know, based off what I was just explaining before about the manipulation being valid, after you see those two steps, you will see a reversal signal and an entry signal that I pretty much take every single time. Now, before we get into that, we can look into why the distribution actually happens. So as we know, the accumulation sets liquidity and that manipulation is needed in order for the big money to position themselves in the actual direction. So with big money positioning themselves over here, what are we going to look to target? We're going to be targeting the ERL low of that accumulation. So the low of that accumulation is going to be our target, and that's how we will position ourselves with the big money. So coming back to this visual right here, what is the third step / the distribution criteria that we're going to look to engage ourselves in? And all that's going to be is an inversion fair value gap or a change in the state of delivery below the last series of consecutive candles. Now, we always want to position ourselves near the SMT, and these two are the best entry criteria of that distribution. Now, let's say we enter off this change in the state of delivery level, which is very close to the IFVG. We would keep our stop here, and what did I mention before? We're going to target that accumulation low every single time. And that most of the time actually aligns with a nice 2R. And this is how your PO3 setup is going to look on the lower time frame every single time. And on the higher time frame, this is exactly what the 4-hour candle actually looks like. Now, with this being said, you can pretty much do a power of 3 of literally every single higher time frame candle. You can do a 4-hour PO3, you can do an hourly PO3, you can do a daily PO3 and a weekly PO3. It all follows the exact same steps, and this is going to happen every single time because these are the dynamics of a candle. So now we can actually take a look at some examples and see how the strategy actually plays out with the charts. Let's fast forward to 10 a.m. opening up. The 10 a.m. candle opens up right on this candle right here. Now let's just mark out this 10 a.m. So this represents the 10 a.m. opening up. All we're going to do is go on to the higher time frame and mark out our key points of interest and key points of reversals. So at this point right here, I'm looking at this ERL, and if we go to the 4-hour chart, we have this nice 4-hour SysD level that we might possibly react off of. So as you can see, we have our key points of marked out. We have this ERL, and we have this nice 4-hour SysD level that we're going to look to possibly react off of. So what I'm looking for right now is I see an accumulation happening. I'm just going to wait for that level to be tapped into and then look for some sort of reversal signal. So we skipped a little forward right now. As you can see, we have this accumulation, right, off that level, off that opening, and we also react off that ERL. Now, what am I looking at right away is this inversion fair value gap on the minute time frame. Now we have this, and you could possibly enter off like, a position like this where you keep your stop at this protected high and then target these lows, right? But me personally, I would not enter so soon off of it. I would wait for a higher time frame confirmation. Now, first of all, we got to look for SMT, which we actually do have, right? with the ES, I have it on the other side, but ES just fails to make this high, while Nasdaq actually takes this high. So we have that SMT right there. Now, off that SMT, I'd go down to the higher time frame, go up to the higher time frame, and ideally I'd be looking for this higher time frame change in the state delivery level, right, to be tapped into. And then after that, I would keep my limit order set here. We have that SMT, we sweep out that, and on the lower time frame, what does it look like? Accumulation, manipulation, and if we got a retest of that level in about 2 minutes, we can take that position. So let's see the next 2 minutes how we close. We close below. And what does that look like on the higher time frame? It looks like a closure below this level. So now all we would do is just market order off that, keep our stop at that SMT protected high, and now we can target the range low, right? Or target a nice 2R. So in this case right here, we're targeting a nice 2R because there's not a lot of targets down below. So this move should continue higher as this is a higher time frame PO3 playing out as well, right? You can see we sweep out this liquidity and we will look to continue lower. So let's go down to the lower time frame and actually see how this actually plays out. And this will be our entry right here. And it matches all of our criteria. We have that SMT, we have that change in the state delivery level, and we also tap into that hourly SIST level and that hourly ERL. So let's see how this actually plays out. If we get a swift distribution, and you can clearly see we get a beautiful distribution of a nice 2R and the strategy playing out perfectly. So now let's do another example on gold here. Now this is a very, very cool example right here, as we're not going to be using the 10 AM power of 3. We're going to apply the things that we learned about the power of 3, and we're going to use a 2 PM power of 3. So I'm just going to mark out the 2 PM candle right here, and I'm going to show you how this strategy actually works in the 2 PM power of 3 as well. If you can't trade during the mornings, you can always trade the 2 PM power of 3. Let's just forward a bit over here and see how this actually plays out. So that 2 PM candle opens up over here, and what we're going to be looking for is that accumulation happening and then a manipulation. So we can just skip ahead. As you can clearly see, we dump like crazy. So what I see here, right, is an accumulation, right? We can mark this out in green. And what do we see? We see a swift distribution, or a manipulation, sorry, down below. Now, how do we know this is valid? We're going to wait until it taps into a higher time frame PD array. Let's go on to the higher time frame and see if we can find a PD array. And we can clearly see this nice PD array right over here. We tap into this gap, right, which is also a 4-hour fair value gap as well as an hourly fair value gap. So we can just mark this out real quickly. But now we can go back down to the lower time frame and wait for a proper valid manipulation. So let's just mark this out real quick. And until we tap into this, see an SMT, and then a change in the state delivery, that's when we enter. So let's just forward a couple candles here and see. So we have a strong reaction here, but no change in the state delivery yet, right? Until we get that candle body closure above that level, we cannot enter. So what does this look like on the higher time frame right now? The candle opens up, right? Let me just illustrate this. The candle looks something like this, where we have that opening, right? We barely have a manipulation, something like this, and we're just wicking and creating that body right now. Now, we had that change in the state of delivery. Let's check for an SMT. We do have an SMT at these lows, right, with silver. They're with this, or it's with this low right here, as silver does not take this low out while gold does. But we have that large higher time frame SMT, right? And off that SMT on the higher time frame, we have this beautiful change in the state of delivery. Now we can go down to the lower time frame and actually fractalize our entry even more, which we don't really get. Our change in the state of delivery over here would be down here. So if you are willing to take a risk, you would do something like this, right? Where you enter off that change in the state of delivery level, keep your stop at this low, this SMT protected low, and then target the opening price or the manipulation of that candle right here. But for me, that personally would be a little too risky, so I would enter off that change in the state of delivery. So you can take a look at this example. I would enter off here, keep my stop at that SMT protected low, this seems like a proper manipulation and a valid manipulation. Now, what would my target be? It'd be a nice 2.2R targeting these highs. You can even target up here. So we can enter off here and we can actually see how this plays out. And as you can see, this is such a swift V-shaped recovery, that accumulation, that manipulation into that higher time frame for value gap with SMT. And then we get that beautiful entry and we take our nice 2R every single time. So this is the premise behind the PO3 model. Now we can incorporate other things like market maker models, which I will be uploading a full market maker model guide on YouTube. So be on the lookout for that one. But yeah, the PO3 guide is pretty much very easy, right? You understand that every candle has an accumulation, a manipulation, distribution, and we're going to trade those kind of dynamics every single time. So I hope you guys learned something, and I'll see you guys next time.